You've seen it before, right? You're scrolling through stocks and you see one first say 200 rupees and another for 2,000. And your brain just screams, hey, that first one's a bargain. It's probably the most common trap for new investors. So today we're going to pull back the curtain and show you a much smarter way to look at the market.
Okay, so let's kick things off with a story that might sound, well, a little familiar. It's about an investor we'll call Arav, and a really simple assumption he made that, honestly, a lot of us make when we're starting out.
So, picture this. Arav's looking at his screen, and he sees these two stocks. The logic seems so obvious, doesn't it? Lower price has to mean it's a better deal. Maybe it's an undiscovered gem. He was totally convinced he'd stumbled onto a secret shortcut for finding a great investment.
But then he tells his friend Mira about his amazing find, and she hits him with this simple but game-changing question. And just like that, those 4 words completely flip the script for him. It's a question that cuts right to the heart of what actually makes a stock a good buy.
All right, so let's really dig into that question. This is where we need to shift our thinking, right? We've got to stop just looking at the sticker price and start trying to figure out what a stock's real underlying value is.
To really get this, let's forget about stocks for a second and think about something way simpler, like buying mangoes. Let's say you've got 2 shops. Shop A sells a mango for 10 rupees and shop B sells one for 20.
So, which one's the better deal? You can't answer, can you? Your brain just knows something's missing. What if the mangoes at shop B are twice as big? Or what if they're perfectly ripe and organic? All of a sudden, that higher price might be totally worth it. See? Price alone doesn't tell you the story. Value is about what you get for that price.
And that brings us right back to stocks. Here's the most important part. With the stock, the quality or the value we're talking about is its earnings, its profits. When you buy a share, you're not just buying a ticker symbol. You are literally buying a tiny little slice of that company's profit stream. That's what you're actually paying for.
So, how in the world do we measure this relationship between the price you pay and the profit you get? Well, lucky for us, there's a super handy tool for that. It's called the price-to-earnings ratio, or, as you'll hear it all the time, the PE ratio.
Now, don't let the name scare you off. The formula is just the stock's price divided by its earnings per share, or EPS. And EPS is just a fancy way of saying the company's total profit divided up among all of its shares. So what the PE ratio tells you in plain English is this: how many rupees are you willing to pay right now for just 1 rupee of that company's profit?
Okay, let's put some real numbers to this. Imagine a stock costs 500 rupees, and we know the company earns 25 rupees for that same share. You just do the math, 500 divided by 25, and you get a PE of 20. It's literally that simple. It means you're paying 20 rupees today for every single rupee of profit that company makes in a year.
Now, the key thing to get here is that PE isn't a final score. It's more like a clue about what everyone else in the market is thinking. A high PE? That's the market betting big, that profits are about to take off. A low PE? That could be a diamond in the rough, or it could be a big red flag that the market sees trouble on the horizon.
Okay, this is the golden rule. You absolutely have to remember this. Context is everything. Comparing the PE of a tech company to a bank is completely useless. It's like comparing the price of a sports car to a family minivan. I mean, they're both vehicles, but they're built for totally different things, right? You should only ever compare a stock's PE to its direct competitors or to where it's been in the past. All right, pop quiz time. Let's go back to Arav and Mira and see how this works in the real world. Mira's about to show him 2 stocks to test his new knowledge. Okay, here we go. Stock Alpha is a 1,000 rupee stock with a PE of 20. Stock Beta is 400 rupees, but its PE is only 10. Now looking at this, your first instinct is to go for Beta, right? I mean, a PE of 10 versus 20? It looks like a no-brainer. Cheaper's better.
But hold on, there's a twist. Mira drops one last piece of info. Alpha's profits are growing at a really healthy 15% every single year. Beta's profits? They're totally flat. And bam! Suddenly the whole picture changes. That higher PE for Alpha makes perfect sense now. Investors are willing to pay a premium today for all that growth they expect tomorrow. Beta's low PE? Well, that just reflects a business that's kind of stuck in neutral.
So, how do you take all this and actually use it without falling into those same old traps? Let's put together a really simple checklist you can use.
First up, the big one, the mistake Arav made. Never, ever judge a stock just by its share price. The fix is so simple, just look one level deeper.
Always check out its earnings and find that PE ratio.
Number 2, don't automatically think a low PE is a screaming bargain. You've got to put on your detective hat here. You have to ask why it's low. Is the business in trouble? Are profits shrinking? Sometimes cheap is cheap for a reason.
And finally, and I can't stress this enough, always compare apples to apples. It is so tempting to look at a list of random stocks and compare them, but if they're not in the same business, that comparison is totally meaningless. Stay in the same sector.
So let's boil this all down into a super simple 5-step game plan. Step 1, find the earnings. Step 2, get that PE ratio. Step 3, compare it to similar companies. Step 4, ask yourself what kind of future is this PE pricing in? And Step 5, go looking for any red flags that might explain why a PE is super low. If you follow this process, you'll avoid so many of the common mistakes out there.
At the end of the day, the PE ratio isn't a magic number that gives you all the answers. Nope, it's the key that helps you start asking all the right questions. And once you've got a handle on this, you can look at other things like price to sales or price to book. But I'll leave you with this one thought to take away. The next time you see a stock with a really low PE, before you get excited, just stop and ask yourself, what might this number be hiding?